One of the big reasons why we moved into ERs is because that dependency doesn't exist. Nobody goes to the ER because Dr. Benson works there.
Yeah. Okay.
Like literally nobody. They go there because their arm is broken, you know? And so we don't have that dependency anymore. So back to your question, how do we grow revenue? It's on us, right? Do we operate well? Do we have a good reputation? Do we have good reviews online? Are people having to wait forever to get their x-rays back?
So today I have Chihiro Kurokawa on with me, and not only is he just a really great guy, but over the years that I've got to know him, he has become a friend. So one of the things that I think is really cool about Chihiro is that he just has a pretty varied background for his age in corporate, multifamily syndication, and now with ZT Corporate, he works in the healthcare industry and car dealerships. So one of the things that you'll hear a lot of people talk about is that when you are getting into alternative or passive investing, you should invest in something you know, or that's the first place you should look. So maybe if you're a healthcare professional, or maybe you've made money in the car dealership industry in some aspect, this is going to be one that you should particularly pay some interest to. And I do think it's a little bit different than a lot of other stuff we've talked about. So let's hop into the conversation. Okay, Chihiro, thanks for being on the show today. Man, I really just like to get started with letting people introduce themselves because you're going to do it way better than I could. So Chihiro, give us your origin story of Chihiro Kurokawa. Am I saying that right?
You nailed it,
buddy.
Butcher it. Yeah, you totally nailed it. Before I go into that life story, I need to let everybody know I've had ice cream with your dad before. I don't think you know this story, but your dad and I, we bonded over ice cream once.
Was that at a financial journey event or was that something else?
It was. Okay. It was in Florida a few months ago. Yeah.
Okay,
yeah.
Cool. Yeah, that's funny. I jokingly tell people he's a weird CPA. So, cause he's really outgoing and, gregarious and all that stuff. So
yeah, a super amazing, fun guy, just like you.
Cool.
But, anyway, yes, thank you so much for having me on here, Jared. I really appreciate it. And so my story begins with me being like a very goalless, non-strategic type of person, honestly, throughout my adolescence and through college. I wasn't very focused on really just strategy. I was, what I like to say is I was a leaf blown through the wind. So how did I choose the major that I studied? Because it was interesting to me intellectually. I had friends in that major. I wasn't thinking about, well, what kind of job prospects will I have and that type of thing. That came to me much later. In general, the theme of me, the person, is I am a late bloomer. And so I majored in environmental science because I loved it. It was fascinating, and ended up working in insurance for quite a while, and in insurance claims, and didn't really find that enjoyable. But
I wonder why.
I had a lot of limiting beliefs at that time. Really, yeah. I really came into my own like in my early 30s going to business school. But prior to that, I had to somehow, some way come up with the confidence to be like, I am good enough to go to business school. I just need to follow these steps in order to qualify myself for that process. So I was able to do that. I got out of the insurance game and then worked in analytics. And I did enjoy that intellectually, doing data analysis at like a huge publicly traded company, which is what brought me here to the Dallas-Fort Worth area in 2016. But there are trade-offs when working at an enormous company. And one of those was there can be a lot of waste, a lot of dead weight, a lot of lack of effort. People can fight over turf. These are just inherent human nature types of things that happen in large organizations. And so I didn't find that quite as exciting as I had hoped. And so I started investing in real estate on the side. And specifically, multifamily syndication is how I really started investing in something other than like a 401k and maybe playing around with some precious metals or stocks as I did in those days on the side. And eventually I got serious enough, committed enough time and effort into that I was able to syndicate my first deal. I ended up doing 4 of those deals, like just under 600 doors as a lead sponsor on those deals. So running everything from soup to nuts on the deal, finding it, raising the capital, etc. And also starting to invest passively into various different types of assets as well along that journey. And then even pre-COVID, I was starting to get somewhat uncomfortable with the valuations out there for multifamily. So for those of our listeners here who might not be aware, there's a cap rate. There's a multiple that is paid on commercial real estate, and those multiples were getting ever greater as this time went on in the late teens, and then after a brief drop or freeze in 2020 because of COVID, then it got white hot after that, as we all know, right?
Yep.
Yeah. So I got uncomfortable in terms of like what people are paying on a price per door basis, and thought, I'm getting uncomfortable paying these prices, and if I'm not buying assets, then I'm no longer an investor. So I really had to figure out what my next step was going to be. If I'm not buying multifamily, I'm just unemployed. I'm not a multifamily investor at that point. So that is how I made the switch into corporate investing, buying, building, investing into, and selling businesses, and that's how I ended up joining ZT Corporate. So there's still a lot of similarities between what I was doing in multifamily and what we do in the corporate side of things, and there's a lot of differences naturally as well. But that's in a nutshell how it kind of came to be, Jared.
That's great, man. I love hearing you talk about kind of like a leaf blown in the wind, because that you don't hear a lot of people acknowledge that. I feel like a lot of people want to say, kind of be like, oh, I was just hard charging all the way. And I resonate with your story because I picked the college I applied to by, do I have to write an essay or not? Don't have to write an essay? Cool, I'll apply there. So then I was in pre-med and I was like, I don't want to be in school for 10 years. So then I was, criminology and criminal justice, and graduated and couldn't get hired as a cop at 21. Surprise, surprise. So that's what, like, all these kind of winding paths is what obviously got me here today. Sounds like you kind of the same.
Yeah.
And then I never worked for a big corporate entity, large scale. I've worked for small businesses, but really what, I was actually talking with my wife about this recently, was the, you talk a lot about kind of being more self-employed or in sales, like we are, either one, kind of a combo. You've been both. And the risk that goes with that versus the risk of being an employee. The default thought is that there's a lot more risk being self-employed, but the flip side of the risk of being employed is you have no control if they keep you employed, right?
Yeah.
You're either employed or you're not, as opposed to varying scales of effort and ability. So
so much good stuff in what you just said right now. So with the risk that people routinely, so W-2 employed types of people, they routinely underestimate the risk of being typecast into an industry or a company, or not typecast, being pigeonholed into that, or that company downsizing, or major market shifts causing that industry to decline, or causing that specific company to decline. All of these things are macro things that are completely out of your control, and people totally discount that, thinking that they are safe and secure because they've been at this company for 25 years doing whatever function. But the reality is, if that were to go away, then that security that you thought you had was really a myth, right?
Yeah. That's well, we'll get off our entrepreneurial soapboxes, because I think most of our listeners are probably, the high paid professionals, doctors and attorneys. So those guys, they can go out on their own, but it's kind of a different ball game, which I think we're going to be touching on that later in our conversation, right? Yeah. But tell me, so you mentioned, we've had people talk about multifamily, right? And you've since left it, but what did you see? Like, why were cap rates getting so the cap rate getting small increased the multiple? That's what you were saying. What did you see creating that? And other than that multiple, like, tell me a little bit about your transition. Dive a little bit more into that, because a lot of people, they go from single family and their next thought is multifamily.
Yes.
So talk a little bit about that.
I appreciate these questions, Jared. So first of all, I still own a co-own. I have two co-GPs on an 80-unit property, so relatively small multifamily deal, just outside of the Dallas-Fort Worth metro. And So I am still a multifamily investor.
Yep.
But to your question, why did that market get so white hot? And on the flip side, why is there so much challenge right now? In my opinion, as a side note, and it seems to be the opinions of other multifamily experts and practitioners, that there's more pain ahead of us in this asset class than there has been behind us. But there's the beauty and the danger of multifamily is the barrier to entry is low, which it's still not super low. It's still easier to just get a job at Toyota and work there than to do your first multifamily deal. All right, it is, and I'm not picking on Toyota. That's just where I happen to work. It's very, very difficult to start up a business or to buy a deal in multifamily or business or whatever. It just is. All right. But relatively speaking, right, I'm the proof right here. I was a manager of analysts at Toyota, and through sheer hard work and being resourceful, I was able to become a multifamily investor. And so that was a pretty high bar for me personally. I guess it took a lot of effort, but it still was, a middle manager at a corporate job is able to do this. And I know dozens of people who achieve that very same thing, doing way more doors and way more deal volume than I ever did. The flip side of that, the challenge is that if that barrier to entry is relatively low, then that means money's going to rush into it, right? Like at some point, multifamily was no longer a secret. There were countless podcasts. There's constantly in Facebook, at least in my network, I would see, oh, here's a closing. Oh, this guy did that deal. This guy sold that deal. Oh my gosh, 3.5.
We're like 2 secrets past multifamily at this point, right? Like self-storage is already the secret that's been exposed. Is it multifamily or not multifamily, like RV parks? Is that kind of the current one that is out the door of being the ideal niche because so many people have moved that way?
Yeah.
But sorry to interrupt you. Keep going. So
you're exactly right. And so
money flowed in.
Yeah, this is capitalism, right? So there's an opportunity, and so money comes in and operators come in, and then capitalism does its job, which is the asset prices go up, and then there is a reckoning. For transparency's sake, like I got completely destroyed in a deal, like totally destroyed. So I'm kind of like living this whole thing right now. But point is, the asset class got hot. A lot of money came into it. I think ultimately the real reason why it's so volatile, or it has become such a volatile asset class, is investing is almost always like predicated on debt financing, right? So my personal opinion is that it's Freddie and Fannie's fault. These are government subsidized lenders that lend at a massive scale. They are the biggest lenders in multifamily in that asset class, with a mandate to make housing more affordable. But of course, when you subsidize something, it does exactly the opposite of what you want it to do, which is to create a stable source of affordable housing for people. And so when you have government-sponsored entities like Freddie Mac and Fannie Mae that are artificially intervening into the capital markets to create lower interest rates, higher leverage than the free market would do, then you're putting gas on a fire.
There's going to be a rebound effect from that.
Yeah. And so my comparison to that is, okay, now I focus my efforts on buying and selling and financing businesses. Typical leverage on multifamily is going to be 65 to 80%, right?
Yep.
Loan to acquisition cost. And you can get higher than that if you get private lending. But, our deals are debt financed at about 50%, sometimes so often less than 50% leverage. And so why is that? Because the free market, there is no Uncle Sam that's subsidizing these loans. This is just the free market. This is lenders, banks saying, this is what we're willing to lever up to, and here's the rates you're going to get. And so I've never heard of a a medical clinic guru selling $30,000 per year memberships, or convenience store gurus, or any of that, right? It seems to be really focused on residential real estate. And I think all of that comes from the debt capital markets.
Okay. Now that's a good point, because you're right. If the average person is able to go secure a loan because the government is backing it or mandating it, then that would make sense. There's a lot more, cash flow available for a guru or someone to capitalize on. So it's an interesting thought. I haven't had anyone phrase it that way, but it makes sense. So let's transition. So, that's what you saw going wrong. Multiple of our guests have talked about multifamily, right? And where multifamily's at. So we don't need to belabor that point mid 2025 again. So tell me about your transition into this corporate investing that you're talking about. What was like the first thing you've done? What just lay the groundwork, and I'm sure we're going to have more questions for you.
Yeah. My personal journey is rather unique in that I knew I wanted to step away from what I was doing, being a solo entrepreneur in multifamily. And this is not to say I did these deals like all on my own. I had partners, and very important, critical partners in every single one of these deals. But my day-to-day was
by yourself.
Was by myself, which, by the way, that was a very significant reason for my shift as well, which is I got super lonely. Like, after I left my corporate job, which they weren't treating me great by that point, but I realized how much I missed just talking to people. Even though we were fully working from home at that point, it was still 2021, so it was still in the depths of like COVID and all that. And yet I quickly realized, oh my gosh, I do not like just being on my own all day, every day professionally. So with those two motivations, I started looking at moving into some sort of a organization. Might be a massive institutional or something that's a little bit smaller. And honestly, this might be anticlimactic, but I ended up at ZT through a executive recruiter. I was, doing all my outreach. I was interviewing primarily with real estate firms. Actually, it was exclusively with real estate firms. I remember talking to a self-storage firm.
So are these like private equity firms, or are these like CRE, like commercial real estate, like brokerages, or
not
everything?
brokerages, operators, investors.
Okay,
yeah.
Okay.
But they weren't. They had grown past like the solo or duo operator type of a role, so they had actual employees. They might have 10 people or 50 people.
So larger funds or larger syndicator operators, stuff like that.
Yes, yeah. Okay. In various real estate asset classes. Nothing really jumped out at me though. Nothing really got me excited. But then this recruiter reached out and said, "Hey, there's this firm. It's not exactly real estate, but it's car dealerships and healthcare." And I was like, what? But he said, but you should talk to them. Like, you never know. And I said, sure. Yeah, sounds interesting. So I did a Zoom and then went on site, toured the facilities, and eventually ended up signing on with ZT Corporate.
Okay. Well, then, good intro to ZT Corporate. Talk about what you guys do at ZT Corporate.
We are maybe a smallish private equity firm. So we just achieved $1 billion in revenue last year, and we focus in two asset verticals. Healthcare is where we got our start, and then about 10 years ago, we diversified into auto dealerships. And so, yes, they are very different businesses, but also have some similarities in terms of durable cash flows, and complementary in some ways as well. A durable consumer product on the automotive side, and then a business that we believe is fairly counter-cyclical in healthcare. Specifically, we do emergency care. So that's something that logic would suggest that people are going to use that regardless of what interest rates are or what's going on with the economy. So we think they are complementary businesses, but our origin story is with healthcare. So the way it all started is our founder, Chihiro, he has always been like this very enterprising individual. he started like a office supply business while he was still an undergrad at Texas A&M.
Okay.
So, and I'm sure he mowed lawns when he was 12 too. You know what I mean? Like he's just one of
Sold
those
candy
people.
door to door or in his class.
I'm sure he did that. Yeah. He's just an enterprising individual. He's one of those people with a very magnetic personality, and just very entrepreneurial. And so he was a wealth advisor, just doing stocks and bonds. And that was in 1997, but then the dot-com bust happened, right? So I was in college at that time, but it was like havoc, right? Like people lost tons of money in that dot-com bust, and including me. Like my grandmother passed away. I inherited like $5,000 and promptly just blew it all buying stocks because I knew nothing, and I was like 20.
Yeah, that'll happen.
Totally. And that was the inspiration for him to say, okay, I want something that has less macro risk. Like I had zero control over the stock market tanking, and he has close family members as well as just people in his community, in his friend group, his closest network. A lot of those people are doctors. And so he decided he was going to start building and investing in healthcare businesses. So that's how we got our start. 2002, we opened our first clinical facility, which was imaging and surgery center and a sleep clinic all under one roof. And that was in Houston. And we've been in healthcare ever since.
Okay, so actually that might be a story that you've told, that I've heard you mention in the past. Now, and I thought was really interesting because he basically kind of had this clinic that was open during daytime hours. And correct me if I'm wrong, but he realized like, well, my clinic is closed for like 10 or 12 hours a day. How can I increase the revenue? And then started the sleep clinic so he could optimize cash flow and create cash flow overnight. Am I remembering that correctly?
Yeah. No, you are remembering that correctly. Okay. So it's not groundbreaking, right? But like it takes a certain cleverness to be like, wait, our facility is completely empty. What if we put in a sleep clinic? And so that's exactly what he did. And,
okay,
yeah,
no, that's cool. And that's you mentioned that what kind of he had done about the stock market, and that's what I'm seeing too right now is that there's a lot of, and that's honestly some of our listeners are probably in the same boat. Like that's all they've done. That's all they've known is the stock market, the stock market, the stock market. And up until recently, the stock market has significantly outperformed like the average. And so if the average was 10 or 11% on the S&P 500 over a 30-year span, like it's been kind of crazy. And then talking to a buddy in personal, wealth management, he's like, oh yeah, we've had a 0.5 point growth this calendar year. And that was after a 20% drop, right? So like just the volatility, which we've always had currently, and I'm not saying today, but like in the market we're in, is not producing outsized returns because you can't produce outsized returns forever, right?
Yeah.
So that's how he transitioned. Great. So like what does a healthcare emergency room clinic like investment look like? Like are not a super necessary part of the conversation, but are these urgent care? Are they emergency rooms? Are they attached to hospitals, other clinics? Tell me a little bit about like, what is this vertical that y'all are operating in?
Yeah. First of all, freestanding emergency rooms, this area, this asset class that we are in, this is a state regulated industry. That's why all of our facilities, we have 31 of them currently, they're all in Texas because the rules in Nevada or Utah are totally different. Hospitals, by contrast, are federally regulated and designated a hospital. So we're not a hospital, right? Okay. None of our facilities are hospitals, although we have done that as well. It's just a different regulatory environment. Okay. So in the state of Texas, freestanding emergency rooms exist wherein a private owner operator like ourselves can operate a emergency room that is completely freestanding, meaning it does not have to operate under a hospital license.
Okay. So interesting.
Yeah. So in other states, they have physically freestanding locations, meaning like a 12,000 square foot box somewhere, right, in the strip mall. but it's operating under Baptist Hospital or, Mercy Medical System or whatever. There's a hospital typically within a certain distance, like 30 miles of that ER. So that ER is like an outpatient department to the hospital.
So that makes, like, so I live on, the west side of Fort Worth. We have Cook Children's in Fort Worth. They have their own emergency room. And then we have like a Cook Children's, and I don't know if technically if it's an ER or if they classify it as an urgent care, even further west, like 20 miles west of downtown, but they don't have full capability that the ER at the hospital has.
Correct.
So,
yes.
So what's y'all's ER like? Is it like an ER light, or are you like full ER, whatever an ER can do, you should be able to do?
It is ER light. I like that. That description. So the way you want to think about this is an urgent care is like an extension of your primary care physician. If one of your kids gets a gash on their arm and you're like, oh my gosh, we're going to need stitches. Like, that's not a Band-Aid thing, right? You wouldn't go to your primary care physician, right? So for that same reason, you wouldn't go to an urgent care either. You would want to go to either a freestanding ER or a hospital ER for something like that. If it's truly of an emergent nature, maybe a gash isn't a great example, but a fracture, that's because there may be urgent care clinics that can do stitches, but
some level of stitching.
But like a fracture, an urgent care clinic really isn't going to be able to do a whole heck of a lot for you. And so you would want to go to either a freestanding ER or a hospital ER. Now, then the next question is, well, what does a hospital ER do, or what are their capabilities compared to a freestanding ER? And the number one thing that distinguishes us is we don't accept ambulances. So ambulances, what do? They transport the most emergent situations, right? Heart attack, stroke, compound fracture, things like that. Trauma, So ambulances don't service us. So by default, those people don't come. But occasionally, a spouse is driving the car. The spouse in the passenger seat is literally having a heart attack, and they're passing right by a freestanding ER. So what are they doing? They're going to pull right in, right?
They see ER. Yeah.
So we will work on stabilizing that patient while we're waiting for that ambulance to come up.
Okay. Makes sense.
Yeah. So what that does is it allows us to take care of most everything that goes to a hospital ER without having the cost structure inherent in hospitals. If you think about it, the most acute conditions, which are going to be a small percentage of patients at an emergency facility, are going to require the most resources, right? If you think of a stroke patient versus somebody who has a fracture, like the number of people involved to save that life, to treat that condition is going to be a lot higher. It's going to be a lot more resources, physical resources like machinery, medication,
labor,
whatever.
Yeah, everything.
Yeah. And so we don't have to have that, and we don't have that because we don't treat the most acute conditions.
Okay, so we're talking about services that are provided. So I'm going to transition that into revenues, right? So people are familiar with real estate, right? That's what you were familiar with. So we've got lease agreements, we have occupancy rates, we have number of units, and you can look at like market occupancy rates. You can increase your occupancy by decreasing your leases, and you can play with all these numbers to produce your pro formas. What does that look like for a freestanding ER clinic? Like, how should a limited partner, a passive investor, what kind of questions are they asking? Because they're not going to have they do not have the resources, ability, knowledge to go verify that information being provided is accurate, right?
Yeah.
But one, so how do you do it? How do y'all do it? And then two, what kind of questions should an investor be asking someone in your same industry, whether it's you or someone else, to try to make sure that they're like within the realm of reasonable?
Yeah. So what we underwrite for is the same level of revenues and expenses post acquisition in that freestanding emergency room, meaning we eliminate the need. If it doesn't pencil without us having to improve profitability, then we're not buying it. because
Okay.
that's our underwriting guideline. And so now what we want to do with that business once we've acquired it is, simply put, we want to leverage our skill, right? So we are the largest operator in this industry in Texas. That means that, our contracts are cheaper, right? Like, we're operating at scale. Typically, when we buy these portfolios, it's a group of 4 or 5 or 6 of these facilities that is owned and operated by the original physician entrepreneurs who started up that business. They have limited ability, for example, to move doctors around. They only have 4 facilities, right? Whereas we've got 31. We can say, hey, Jared, can you go to Abilene next week? Like, Dr. Johnson's out. We can do things like that. So it's really just basic economy of scale type things where we leverage supply chain benefits, software contracts, and flexibility. And then we have less of a need to outsource services as well, because we're at the scale where we can have in-house operations like, finance, accounting, et cetera. And then we might even take traditionally outsourced services like billing, for example, and we might do that in-house if we have the scale to do that.
Okay, so really part of what you're saying is you can professionalize it, right? Because you basically have operators who have started a business and who are hopefully good operators, right? Hopefully they're good doctors, but a good operator does not equal a good business owner, right? And so you're going in,
or a good doctor doesn't necessarily mean a good business owner, but a good operator definitely is a good business owner.
Yeah, correct. Okay. And so then I guess my kind of to drill down on the revenues, and you say you use actual revenues from when you buy it. Now, are y'all doing are you making sure these are stabilized revenues? Are you, is it like 2 years worth? Is it 3 years? What does that look like when y'all are making sure that the revenue number is reasonable?
One big differentiator between multifamily, where I cut my teeth, and what we do today is, in multifamily, there's kind of I won't share, if I'm a seller to you, it's like, I'm not going to share the real information. It's on you to figure it out.
Buyer beware, basically.
It's buyer beware. And furthermore, it's like, Jared, if you want to step foot on my property, and you want to buy this property, like, I need earnest money, or, like there's kind of strings attached, right? Like, you got to show me something before I show you anything. That's kind of the prevailing relationship between buyers and sellers in multifamily. Yeah. In what we do like a very intense deep dive through a third party. So we don't even do this. We have a third party company that will run due diligence on an asset that we're considering for purchase, and they are going through the books. So it's a full-on financial audit that we pay for at a significant expense before we even go under contract. We do that when we're under LOI, and so that dynamic is very different between sellers and buyers from one asset class to another. But both on the dealership side and the healthcare side, we will have significant confidence in the financial performance over the last 12 or 24 or 36 months based on the financial audit that is conducted by this accounting firm that we'll hire. Okay. That's called quality of earnings.
Quality of earnings. All right. Well, I'm going to ask you a question that might be kind of morbid, because you've already shared what y'all can do basically on cost cutting and optimization, right? What options are there to increase revenue? Because you're emergency services, right? So you're kind of taking business opportunistically when they need you. But what ways do you have to increase revenue?
Yeah. So marketing is really, really important. I'm going to go on a segue here, but we've done a lot of healthcare businesses, right? Okay. All clinic-based, doctor-centric types of businesses, a huge variety. We've done over 50 limited partnerships. And one thing that is that can be a strategic weakness in those types of businesses is if the doctor is responsible for business development. So here's a perfect example, like a med spa, right? Dr. Benson runs the med spa, and the clients go there because they love Dr. Benson. Dr. Benson wants to move or retires or sells it. Now it's Dr. Smith. That relationship is gone, right? And so we've had experiences doing businesses where the physician operators are responsible for business development, bringing the patients in. And for whatever reason, that didn't work out quite as well as we had hoped. And so we learned firsthand these kind of strategic dependencies, right? One of the big reasons why we moved into ERs is because that dependency doesn't exist. Nobody goes to the ER because Dr. Benson works there.
Yeah. Okay.
Like literally nobody. They go there because their arm is broken. And so we don't have that dependency anymore. So back to your question, how do we grow revenue? It's on us, right? Do we operate well? Do we have a good reputation? Do we have good reviews online? Are people having to wait forever to get their x-rays back? Oh, maybe we need to change the radiology group that we partner with because these people aren't turning it around quickly enough. All of that is much more within our control. And so we do like being in a retail oriented business where people are going to come to us because we've generated name recognition. They've seen our social media ads. They've driven by the billboard along the interstate, all of those types of things. And then additionally, we work very hard on community partnerships, right? So do we have a relationship with the fire chief? Like, do they know about us? How about like sports leagues? Kids get injured. Like, do they know that if they go to one of our facilities, the wait time on average is 12 minutes or whatever it is versus, however long it is at the local hospital. So it's that kind of day-to-day like marketing effort that is very, very important for revenue generation.
Okay. Yeah, it's like business development as opposed to direct sales. You got to find a way to increase the maybe the brain space that you occupy in the community's mind around that stuff. So if you're the ER in their head and something happens, that's who they think of.
Yeah, absolutely. So one billboard that we have is like, here's what the wait time is right now at our facility. Next exit.
Okay. All right.
And often it's zero. So those are some of the things that
I like that. Okay.
That we do. Yeah.
Well then, all right. Well, I'm gonna use this as a slight transition. We'll probably come back to some like due diligence questions in a minute, but you also do car dealerships. So are those investments commingled or are they typically done separate?
Yeah, we keep them completely separate because they're very, very different businesses with very different dynamics.
Okay.
And in terms of offerings, like on the dealership side, at least to date, they've been very income-oriented investments that are really the key feature is like capital preservation. Whereas it's more like traditional common equity type investments with upside potential on the healthcare side. Now that's of course subject to change, right? Like we internally discuss like what's the best kind of deal to bring forth, but not traditionally, but at least for the last few years, that's what we've done.
Okay, so what do car dealership deals look like? Like what is going on? You said cash flow. So, are you just buying an operating business at a multiple and getting a return on the money? What does that look like?
Yeah. So it's going to be like high yield fixed income type of deals that have like a fixed maturity, like a 36-month or a 5-year termination, meaning we're going to get you out within 4 years or 5 years, because if we don't, then we have self-imposed a penalty to us. Meaning your rate goes up. The rate that's paid to you monthly kicks up. So then we're incentivized to get you out prior to that kicking up.
Okay. So those are more kind of like fixed returns, kind of like a debt instrument or
preferred equity.
Okay. So preferred equity. Okay. That's a term that we're more familiar with now. So preferred equity, they're getting cash flow. What kind of intricacies go into a car dealership? Because like you're the only, I've heard other guys doing the some sort of medical type investment. I don't know anyone else doing car dealerships. So give us the 30,000 foot view of what is going on and pros and cons.
Yeah. Here's the number one thing to know about dealerships, the business, dealerships as a business, is they are all And I'm strictly talking about franchise dealerships. A Nissan dealership, BMW,
Not
that has a
used car lots.
manufacturer brand, not used car lots. That's a very different and arguably much more difficult business, honestly. So with franchise dealerships or new car dealerships, each one of those is a mini monopoly. You see autoplexes all the time, right? Vandergrift, like they've got multiple manufacturers, like literally right next to each other. And that's very common throughout this country. But you will never see, and I try to shy away from like absolutes, but you will never see two BMW dealerships right next to each other, or two Nissans. It just will never happen, because the nature of the franchise agreement between us and Toyota at Toyota Fort Walton Beach, Florida, is that we have a guaranteed relationship, or a guarantee to a certain geography with Toyota. Toyota can never put another Toyota dealership in within a certain proximity to us. That's how every single franchise agreement is. And so that means we are the exclusive seller and marketer of new Toyota vehicles within that designated geography. And that is what's really powerful, and really is why, incidentally, at the same time that we got into this business in 2015, Berkshire Hathaway got in, because Warren Buffett, he loves businesses with moats, right? They just went in at 80 stores at one time at a massive scale, and we bought 4. But the motivation was the same, which was to get into a protected business that has a moat around it. And so that is what's interesting to know about the dealership business that isn't necessarily common knowledge. So the other interesting thing about dealerships is the biggest revenue driver is almost always going to be new car sales. But the biggest profit driver is typically the service bay, the maintenance of that car. So Elon Musk famously said, and he was being cynical about it, but it's accurate, that the legacy automakers sell new cars only so that they can fill their maintenance drives. Just so they can have more demand for service. And, again, it is kind of cheeky, but, there's truth to that. And so it really ends up being, yes, it is a sales business, but like, in my opinion, truly successful dealership owners and dealership operators have great operations. Like, they're awesome at inventory management. They're paying their technicians well, so that they don't have constant turnover. They're diagnosing cars correctly in the service bay, and not having rework or minimizing rework. That is, in my opinion, the most important part of running a dealership business well.
Okay, so I'm trying to think what question I want to ask next, because you already mentioned like who you're typically buying these ER clinics from. Typically, it's a doctor or a group of doctors who partner together. They got a couple of facilities up and running. They've probably hit capacity on what they're able to manage, and maybe they realize they like being a doctor better than than a business owner. And now they have a payday in front of them. So, who are you typically buying these car dealerships from? Are you starting brand new car dealerships with the major automakers, or are you acquiring them from someone else?
We are acquiring dealerships at present. Now, we have built physical facilities from the ground up, but we haven't, in our jargon, we call it putting up a new point. We haven't done that, putting up a new dealership from nothing. Who we are buying from is, so dealerships, it's a really hard business. Like, when I meet the car guys, the people on the operations team, the people who do real work, not like me, of selling cars and doing these complex operations in the business, like, they are a different breed. Like, these people live and breathe and absolutely love cars, and I get it. You have to be that way because it's such a hard business. If you don't truly love it, like, you're just going to burn out. So the nature of being a dealership general manager or a highly involved dealership owner is you're working 363 days a week. You got Christmas and Thanksgiving off. July 4th, family wants to go to the lake. Have fun. Like, this is a huge selling day. Like, I'm at the store. right?
Yeah.
12-hour days, because when people get off work, they come in to buy cars, so I need to be there, right? And the businesses within the business are quite disparate. So, of course, we've got new car sales. Of course, you have used car sales, right?
Yep.
But within that, you got regular used cars and you have certified, and then service, parts, and finance products that you're selling. All of these are really different businesses. One of them, in fact, isn't even B2C. Like parts, you're selling to local mechanics, right? That's a B2B business. So how different is that from selling new cars? Which, by the way, is pretty different from selling used cars. The sales strategy is totally different, right? One's a more price-sensitive buyer. That what they're looking for is different. And so what that means is, practically speaking, on the ground, when you walk into a dealership, the general manager is rarely in their 30s. They're almost always like a 40-year-old GM is pretty darn young, because like usually the GM at a dealership, they've run through each of those very different businesses and showed proficiency, all of that, in order to rise to that position of being the general manager of a store. It's really hard to get there. And so all that to say, one of the big challenges in this industry is succession crises, because like the second or third generation person whose last name happens to be Huffines or Vandergriff, grandpa started the business. They're like, yeah, how much can we get for selling this? Yeah, I don't want to sell this, or I don't want to work here. I'm not going to take in this business.
They were raised very well off and not having to put that many hours into it, and now it's their turn to run it, and they don't want to do it anymore.
Yeah, and they're like, wait, what's the multiple on this? Like, we're going to make how many millions of dollars? So, so that is a constant challenge in the dealership business, because it is a very, it's a hard business to be in the operations of a dealership.
Okay, all right. So I want to transition to like very specifically, and I'm trying to figure out like, because these are two very different models that you're talking about, right? Two very different investment categories. And like I've already said, these are two categories that your average investor, limited partner, your doctors might have a little bit of a kind of a behind the curtain look when it comes to operations of clinics, right? But when it comes to car dealerships, most people are just going to think, I got to get in there and out of there as fast as I can, right? That's really kind of what a lot of them are thinking.
Oh, you mean from a consumer standpoint?
From a consumer side, that's what they're thinking. So as they're considering investments like this is so far out of their normal experience zone. Like, this is where we need you to come in and say, all right, if you're talking with, if you're talking with me, or if you're talking with someone else pitching these types of investments, what are the best questions that, an investor could be asking the fund manager or the syndicator?
Yeah. Not going to lie, like, if I'm pitching one of our dealership deals, like, it does require education, right?
Okay.
Like, the stuff that we just talked about over the last few or several minutes, like, that is not common knowledge stuff, right? So that is a part of it. And, there has to be a fit. There always has to be a fit between the deal and the investor. Like, we have to meet a need, right? I think one of the many lessons that I've learned being full-time in investments now for a while is we have this tendency as people to just focus on the upside, and we don't understand the risk, and it's hard to focus on the risk because you never realize the risk until it punches you in the face, right? So if I did a super risky deal and I got a 5x on my principal, like, I don't care what the risk was, because I got the 5x. Only in hindsight, in hindsight, if I'm a thoughtful person, might I look back on that and say, holy crap, like, that was an insane deal. Like, I'm glad I got out at a whatever percent return that I got on it. And that's how we mature as investors. But sorry, totally got sidetracked there. But my point is that a lot of on the dealership side, there is the education about the business model. Okay. And furthermore, it's a lot of it's going to be fit between people who are more cash flow or income oriented investors as opposed to somebody who are willing to take on more risk by doing an equity investment.
Okay, yeah, and so that's good. So on one hand, they need to make sure the person they're working with will take the time to help them understand the deal. That's part of it, right? It's not because there's nothing you can say that's going to help them understand every deal. And then the second part of what you just said, I like because we've said it in the past, and we both got connected through Keith's group. So, what Keith talks about is one of the first things you do before you go when you start looking at all these deals is figure out if you are in like equity growth mode or wealth preservation mode, which might be cash flow or safety, and if you're in preservation mode, you're naturally going to be looking at, typically lower returns. We'll say lower in quotation marks. That could vary based on the asset class, but that's because you take a safer position, you take a lower position on the capital stack, whatever you want to say. So, okay, so that's one. So let's talk about what are some red flags in your specific niches that an investor should be looking out for.
Yeah. Let's start with healthcare. We are not distressed or turnaround type investors, which is I don't want to say we'll never do that, but our track record thus far is not comprised of those types of deals. We may do that in the future. But so for us, we focus on deals that are performing well, that have strong revenues, that have strong operating margins and earnings margins. That's a must for us. Also, so one thing happened by way of background here. This industry of freestanding emergency rooms in Texas has only been around for about 15 years. We were an early entrant into this market by opening we built our first facility because there were none to buy, right? They had to be built from the ground up. So we opened that in 2012, our very first facility. And, being that this was a brand new business opportunity at that time, what the heck happened? A ton of money came in, a bunch of these popped up all over the place. We estimate that at its peak in 2016, there were about 300 operating licenses in the state of Texas. Today, there's 225 to 230. So a bunch went out of business because money rushed in, it was oversaturated. And so the reason we were able to sustain ourselves through that and then grow past that point when there was headwinds in the industry is because we got patient, right? We saw what was going on and we said, okay, we got to pump the brakes. Let's focus very intensely inwardly on operations so that we preserve margins and make sure we don't go under, and certainly we need to wait and see how everything shakes out. There's probably going to be some distressed opportunities to buy once all the chips kind of settle. And so for 3 years, we didn't build anything. We just waited. We focused inwardly on optimizing operations. And then 2018, we got back into the game by acquiring 6 facilities that were financially distressed, but not operationally distressed. And we liked the locations that they were at, and we liked the branding. It wasn't a distressed brand. So they had strong brand equity, strong ops. They were just like over-levered. So we bought those out of bankruptcy. And so since then, we've strictly focused on buying existing facilities.
Okay. So, and I'm gonna ask it again because we got a little off topic, but if someone's looking at these types of investments, what are the red flags that should scare them away from something?
Yeah, sorry, I got totally distracted.
No, you're good. You're fine. I like where we went. I just want to, I want to kind of throw out maybe the crazy stuff you've seen, or maybe it's even things where y'all decided internally, like, hey, we're not going to do it like that because it doesn't benefit the investor, right? And so, in either one, car dealerships or clinics, what are red flags that someone should be looking out for?
One of the bigger risks in this business is going to be a new competitor popping up, know? And so the density of emergency medical facilities in your specific area is going to be important.
Okay.
Yeah. We don't honestly we don't own any assets in like very densely populated areas. We're very much focused on suburbs, exurbs, and then more isolated markets. Think of like an Amarillo, a Lubbock, a Tyler, those types of markets where there's just less competition. So I would be concerned about the concentration, like a market just being oversaturated.
Okay, an oversaturated market, and making sure people have done their due diligence on that. Okay, all right, and I'm gonna take this like real broad, and I want you to put your passive investor hat on. When you've invested with other people. What's been one of the most egregious terms or issues you've seen in a PPM that you think that investors should be on the lookout for?
Yeah,
this is the salacious part. What's the craziest thing you've seen?
So, honestly, I hesitate to say this is the operator's fault, but like, I don't know if you remember this, but you held a little session on like leveraging ChatGPT to like read a PPM.
Yeah, we won't say any names.
Yeah, no, absolutely not. But like, I don't know if you remember after you did that, the example that you used was literally the operator that I had invested in, unfortunately.
Sorry, Chihiro.
Yeah, so for the audience, like, Jared, held a session showing people like, hey, here's an example of a bad PPM. We're going to go dissect this thing using ChatGPT. And unfortunately, I had invested in that deal. And so the lessons learned from that, for me as an LP, is it was a new asset class. So I should have done a heck of a lot more due diligence on it. You know what my due diligence consisted of was talking to my friend who turned me on to these guys and asked them, hey, how long you been in the deal? Oh, I don't know, 8 months. How the distribution's been? Oh, it's good. And like, that was pretty much about it, And so, I'm in a, I won't say bad deal, remains to be seen, but a deal that does not give me the warm and fuzzies. One of my least favorite deals is one that I got into because I did not prepare well enough. So I should have gotten more referrals. I should have talked to more people. I should have talked more in depth with the one guy that I talked to. I should have read the PPM. Shame on me,
That's a lot of pages, man.
Oh my gosh, that PPM is, I think hundreds of pages. Which,
it was,
by the way,
literally 265 pages, I think, or it was over 250 pages. And just while we're on the topic, I am actually, for all the listeners, I'll have a kind of a cheat sheet on how to use ChatGPT coming out shortly. It should already be available. You can sign up for it in the description. But yeah, that was something that I thought was really useful for a lot of people.
I totally want that ChatGPT prompt.
Okay.
So that's, speaking of a red flag for you listeners. Yeah, a 250-page PPM, like, that's not normal. Typically, it's like maybe 100 pages. I've seen 100-page PPMs, but like 250 suggests that they are just obfuscating. They're just hiding things in an ocean of words.
Ocean of words. I like that.
So that's so to sum up, I didn't read the PPM, or I did a very cursory review of it. I did not get enough references of current investors, and didn't do enough research on the reputation of that firm. And so that continues to be a learning for me, because I'm still in that deal. I would also say that important questions for an LP to ask are, how long have you guys been doing this? Like, what's your level of experience? What are some of the learnings that you have had in this specific business model? Like, what are some of the challenges that you had? There should never be an answer where it's like, oh, we haven't really had any challenges. Like, that person either is lying to you, or they don't know enough about their own business.
Or they don't have enough experience,
or they haven't
to
been
justify.
Doing it Yeah. So an important question to ask is, tell me about like the worst deals that you guys have had. Like, what of those look like? What did you learn from them? How did you recover? These are discussions that aren't pleasant, but they have to be made between a prospect and somebody like myself.
Yeah. Okay, dude, that was great. Thank you for all that information. Why don't you tell our listeners how they can best get a hold of you if they want to, have conversations with you directly, want to find out more about what you do?
Yeah, I'm on Instagram at CG Kurokawa. So I say this
We'll
all
put
the
it all
time.
in the description below. You don't have to spell it out. Nobody.
Yeah, I'm very easy to find. The hardest part about finding me is spelling my name correctly. But I
Yeah.
will tell you that Japanese names are very phonetic. They may be foreign to you, but it is phonetic. So Kurokawa is my last name. In any case, CG Kurokawa is my handle on Instagram. I can be found on all platforms, LinkedIn, Facebook. Yeah.
Awesome. Well, we'll get all that in the description. Chihiro, thanks for being here. I enjoyed learning more about the specifics of what you do, and I hope our listeners did too.
Yeah. Thank you so much for having me here.
Absolutely. Okay, so if you enjoyed that conversation with Chihiro as much as I did, go check out his podcast, Beyond Stocks. And if this is your first time on my show, make sure you hit that subscribe button. And one of my takeaways, I think, from my conversation with Chihiro is just the value of operations, right? You can have an amazing pro forma. You can have an awesome business plan. You can buy a really great deal. And if your operations or if the general partner's operations suck, all of that can be for nothing. So if you need any help with due diligence, my last call to action for you today is go check out that due diligence guide I have in the description below. And until next time, I will talk to you later.